It's Super Bowl weekend. Josh, how do you think the stock market's going to react to the Super Bowl on Monday?
It's going to depend on who wins the game. So there's actually this cool thing, which is called the Super Bowl effect. And over the last 54 Super Bowls, if the 40 times it's actually predicted correctly. And what we want to happen, and this is not just because we're in Los Angeles, David, we want the NFC to win. Because if the NFC team wins, typically, the Super Bowl effect would tell you that the stock market is going to have a good year, it's going to go up. But if the AFC team wins, that's bad. And again, not just because we're rooting for Los Angeles, the hometown
Go
team,
Rams.
but um, but this doesn't really make any sense. So I always think we like to think about stocks and sort of think about company, valuing companies and information. And if the Rams win, I don't see why that should have any impact on Disney doing well for the rest of the year, or Alphabet doing well for the rest of the year, or Apple doing well, and naming only the big companies, but just take that to the market as a whole. So
right, there's no new information coming into the market.
Right, it's just some team randomly won. So it's sort of an issue with something that we like to call it's correlation, but that doesn't necessarily imply causation. However, this past week there was some really interesting, let's say, information events happening with certain companies, and so I was hoping you could talk to us a little bit about Astra.
Right. I love aerospace. I love the rocket industry. I think it's such a cool industry, and I think it's got such an exciting future. And this week, rocket company Astra tried launching a rocket from Florida for the very first time. Before we get to what happened, I want you to think about what the price of Astra stock should be. Because if all financial theory is correct, the price should be based on two things: the future cash flows from the stock and the risk of the stock. So here I've got what the future of Astra was expected to look like. Some rocket launches each year off into perpetuity. And we could, if you want, we could put numbers to those. So let's say all these rocket launches each year in perpetuity generate cash flows of $100 to the shareholders. And it's a risky business. So I'm just throwing up, for example, a required return of 25%. So we have our cash flows and our risk. And if we think of it this way, it's just a perpetuity. It's just a stream of cash flows, equal dollar amounts that go on forever. And so we can discount it using the perpetuity formula and find that the price of the stock today should be $400, assuming nothing goes wrong with this launch in Florida and they get to do all these launches in the future. But Josh, what happened?
Something went wrong.
Something went wrong. What you're seeing, this is so heartbreaking. What you're seeing is a rocket with its engine lit, spinning out of control above the Earth. This is the launch that went from Florida yesterday. And so this is really a problem for the company, because those launches that were expected are not going to happen as we expected. And so what happened to the stock price?
That also spun out of control down, So this is looking at just the past two, Wednesday and Thursday. We're recording this on Friday morning, and actually the stock price has dropped even further this morning. But this is the actual reaction to the news, and you can really pinpoint exactly where the rocket exploded, which is this point in the middle of the day on Thursday, February 10th. So David, can we go back to your sort of the example you were giving with the rockets and sort of show how this actually plays out mechanically with the stock price? Why did it actually drop?
Right. And so unlike the Super Bowl, where there's no new information coming into the market, this is new information coming into the market, because now investors are concerned that we're going to lose some launches on the timeline. So I've taken the first 2 years worth of launches. I put the explosion here, and I've taken launches off the timeline, because now they're going to have to go back into development and fix the problem. And that might mean no cash flows for 2 years. And you might think, well, 2 years, that's not that long. They surely can't lose 40% of their value by losing 2 years of launches when they've got a perpetuity, a forever of launches after that. But this is how time value money works. Time value money puts the most weight on the most recent, the nearest, the soonest cash flows. And so when you take those two cash flows off and discount the perpetuity again, you get a price of only $256. So just taking 2 years off the timeline, the first 2 years off the timeline, you get a 40% decrease in price, which is almost exactly what we saw in the stock market. So it's a really nice example of how the stock market does in fact support all of our existing financial theories about stock prices.
Which is great to hear. David, may your weekend be less explosive.
Yours too. Take care.